Hello, everyone, and welcome to our fourth quarter investment outlook from us here at eToro. I hope you are all doing well. We titled it Change is Coming, Time to Value. Please do remember to like, share, and subscribe if you are watching on YouTube. And if you are on the podcast and want to follow along, the link is in the bio. Please as well do remember that this is a marketing communication and should not be taken as investment advice, a personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. I mention this every time we do it, but it's a pleasure to host these events and also be joined by some of the finest minds we have here at eToro. For those that are watching on YouTube, you're about to see them all wave. For those that are on the podcast, our amazing analysts are waving to you all right now. Brett, JP, and Neja, our US investment analysts, our global market analysts and market analysts. And of course, Neja joins me on the Market Bites regularly as well. JP, I'm going to start with you to kick this off. What have been your key takeaways over the last quarter?
Yes, thanks, Sam. And so nice to do this together again. Yeah, the key event in Q3 was the first rate cut by the Federal Reserve in the US. We've been talking about it all year. When will it happen? We mentioned it on our Q3 outlook. And in September earlier on, it was so far. Yeah, and it was needed as well, because if we look at the equity markets, they had gone sideways in the third quarter after, you could say, 1.5 years of rally. Now companies started to struggle with the high interest rate, so it's a welcome cut. If you look at equity markets, you also see this rotation that we have been talking about before. The Dow Jones, which has more value stocks and fewer growth stocks, outperformed the S&P 500 and also the tech-heavy Nasdaq that went down 6%. In Europe and Hong Kong, markets stay flat, and the Japanese Nikkei index lost 6%. In Asia, we also see that China in Q3 was still struggling with the property crisis. But yeah, you know, recently the China government started to stimulate the economy. And there you see again another form of rotation happening in the markets, with money going to markets that are cheaper, you could say, with lower valuations. I think the Fed was right cutting these interest rates because we saw the economy weaken. Inflation was clearly lower, so that was not a problem anymore. And unemployment had been rising. And so I think the Fed with 50 basis points was right, because they see the economy normalizing and they want to help that. With respect to sectors and asset classes, so we think the asset rotation that we have seen in Q3 may have legs and may continue into the fourth quarter.
Thank you, JP. And I actually just want to invite everyone that's watching this. Obviously, if you're on the podcast, click on the link and let us know. What was the main thing that stood out to you in the last 3 months? What do you think has been the biggest headline of note? JP, we've titled this slide quarter 3 versus quarter 4. What have you got for us?
Yeah, you see it here. So also in numbers, other sectors that were lagging in 2023, like real estate, is now on top of the list. It's a rate-sensitive sector. We could have included home builders here as well. Neja will talk about it in a minute. And if we look at the bottom, you see commodities struggling, which comes together with slower economic growth. And also the US dollar had been declining, and that's what we expected in the previous quarter as well. If we look at the agenda for the fourth quarter, making that turn, looking into the future, we have a couple of corporate events like the Amazon Big Prime Days, JP Morgan kicking off the earnings season on the 11th of October, with NVIDIA more or less closing it somewhere half November. We have 2 times the Federal Reserve, 2 times ECB on the agenda. And we have a couple of political items like the climate conference and another OPEC meeting on the agenda.
I feel like I say this every single quarter, but it's going to be an interesting one. And looking at some of those events there, bring it on, I say. JP, let's talk about potential quarter 4 drivers, how you see it over the next 3 months.
Yeah, the key items are further rate cuts, at least that's what we expect. High earnings growth to continue, also in the usually strong fourth quarter. And what I should have mentioned on the agenda as well, the US elections, of course, on the 5th of November. So point one is we see the Fed cutting further. That's because they see economic growth longer term at 2%. They see a peak in unemployment at 4.4, and they see inflation gradually coming down to 2%. So there's no need for above average interest rates. And we see them cutting to something like 3.4%, or at least that's what they indicate themselves by the end of 2025. What a lot of people tend to forget, because you see the economy weaken here and there, is that there's still double-digit earnings growth ahead on both sides of the Atlantic. So we have institutions like FactSet and LSEG who give us these numbers, and they look at a pool of analysts, and they expect 15% earnings growth in Q4 for the S&P 500. And also something like 12% earnings growth for the European stocks 600. But as I mentioned, there's always, worries in the market. One of the things, short-term worry, is these US elections, as I said, on the 5th of November, that can always cause some volatility. But also another thing on the geopolitical front, there is a BRICS meeting. That's a bit the autocratic counterpart of the G7, with Brazil, Russia, India, China, and South Africa meeting in Russia by the end of October. And that may also cause some worries in the market. But on the other hand, we're still positive on the outlook based on lower rates and higher earnings. And to mention, historically, Q4 is often a strong quarter for cryptos like Bitcoin.
Yeah, I can imagine the crypto lovers will enjoy that last point there. But of course, as we get into November, it's going to be one of the most important months of the year. And I want to encourage everyone who is watching and listening to this again, let us know, what do you think is going to be the main event for the next 3 months? What are you most interested in? And also, thank you for getting involved in our online survey, which we did recently. JP, what stands out to you from this?
Yeah, this is the part of our quarterly that I perhaps like the most, asking what other investors think about it. And there was a very good response. Over 1,700 people responded to this questionnaire. Yeah, and it's funny to see that for a part, they have the same view as we have. You see the rotation here as well. Stocks is a little bit lower favored in Q4. And also, if you look at sectors and themes, you see tech at a lower number, and basically all the other ones at higher numbers. The only thing that is perhaps slightly different than the way we view it is that the investors polled in this survey see the US still being the favorite country over the other ones. And well, that's always nice. Then we have some discussion and we will see what will happen.
Yeah, absolutely. Thank you, everyone, for getting involved in the poll. And if you didn't, and you want to voice your opinion, the comment section is open to you. Let's now move on to the US. And Brett, thank you so much for joining us today. What have you got for us on this slide? You've gone with "Don't fight the Fed."
Yeah, thanks, Sam. We're finally back to the phase where the saying "Don't fight the Fed" is back in play. The Fed, as JP mentioned, has cut interest rates for the first time since 2020, and we're now embarking in a rate cutting cycle. And I think a lot of times that can be it can conjure up some fears among investors, because when the Fed's cutting rates, a lot of times it's around a crisis, like last time was around COVID, and or around a recession. And that creates, inevitably, that makes people a little worried. But there's times too where the Fed has begun a rate cutting cycle. And you can see on the chart on the right, that's exactly breaking down the returns from when the Fed cuts rates or begins a rate cutting cycle and orchestrates a soft landing where the US doesn't go into a recession. And that's not to say there's no concerns about the current environment. Right now, the biggest worry is the jobs market, which, again, as JP mentioned, has shown some softness in the last couple of months. And given that consumer spending is the lifeblood of the US economy, well, jobs are pretty important. But it's not all doom and gloom. You know, that is a concern, and I don't mean to make light of that worry, but overall, when you look at the picture, the US is doing pretty good. The Q2 GDP print just came out at 3%. It's very solid growth. Retail sales continue to hum along. And when you look at the S&P, we just came off one of the best quarters of growth in several years. So looking forward, estimates are just estimates. You know, the risk to those are that they can change. But right now, estimates call for double-digit earnings growth in 5 of the next 6 quarters. That's very, very strong growth. And when we look at the different sectors, we have a lot of participation. If you go back, you know, if you remember about a year ago, looking at the market, the S&P was doing pretty well, but it was on the back of mega cap tech, basically the Magnificent Seven, and you know, throw in Eli Lilly was doing really well, but everything else was really kind of struggling to stay afloat. But now, when you look at the market, we have 10 out of the 11 S&P sectors are up 12% on the year or more. So very strong performance, a lot of participation among the different sectors, and it's not really just tech doing the lifting anymore. They're actually just the fifth best performing sector. So when you look at sort of the positives that we still have in the US, whether you're looking at the economy or the market, and they are two different things, admittedly, but when you look at them both, they both have positives going for them still. So we have to be cognizant of the risk, but overall, the picture looks pretty good.
Yeah, thank you. And thank you for putting in the table there. Fingers crossed it's going to be more of a 1979 than a 1981 kind of market. But time will tell. We have another slide here, Brett, just having a look at some of the performances over the year so far. How do you see it at the moment?
Yeah, you know, we are just talking about the sector performance and how so many different groups are doing really quite well. Energy is really the only sort of laggard at this point through, you know, through the first 3 quarters of the year, and that it's not even down on the year. So that speaks to how well the market's been doing, how good of a year 2024 has been to broad-based index investors. But I think when you look at tech, it is kind of interesting. You know, we've had the S&P 500 and the Dow make all-time highs multiple times through the month of September. The Nasdaq hasn't made new highs since mid-July. And a big part of that is Magnificent Seven is responsible for that. And only one Mag 7 name has made a new high recently, and that's been Meta. So we've had this pretty clear rotation and profit taking, I think, out of tech, out of mega cap tech, and into small caps, into value sectors, and into utilities. Real estate's done quite well. So we've seen this like big rotation out of tech and into different names. And I don't necessarily expect the other names to do poorly moving forward, but I do think that there is an opportunity in tech for some of that money to rotate back into the Magnificent Seven, back into tech in general, and for the NASDAQ to join the party and make some highs as well. When you look at the earnings growth in tech, it's quite strong, focusing specifically on the Magnificent Seven. The forward 12 months of earnings are expected to grow 21%. That's more than double the S&P at just about 10%. And while other non-Magnificent Seven names are doing well and earnings growth is returning to them as well, these are household's favorite name. These are household names, investors' favorite names. I do expect some money to rotate back into tech in the next 3 to 6 months.
Yeah, thank you very much, Brett. And again, if you're watching this, if you're listening to us, let us know, are there any particular sectors you're really focusing on? Let's get a conversation going. One of our favorite things about eToro is the ability for everyone to get involved and share their thoughts, of course, as a social investing platform. Neja, we'll now move to you here, and we've gone for under the radar, small caps and home builders. What have you got for us?
Yeah, today I decided to talk about small caps and home builders. Both of those were already mentioned by JP and Brad. And if we start with small caps, so far this year, small cap stocks have really underperformed to their larger counterparts. And with market capitalizations ranging from roughly $250 million to $2 billion, small caps are smaller in size, but they can offer a significant growth potential. And contrary to common belief, small caps are not startups. They are well-established businesses with solid financials, and they simply have smaller market values compared to larger cap peers. And if we take a look at the main index, that's Russell 2000 index that tracks performance of small cap stocks, it has risen about 10% year to date. And that's less compared to the S&P 500, which is up about 20% year to date. However, since July, the performance gap has narrowed significantly because since July, Russell 2000 is up about 8% compared to SP 500, which only gained around 4%. So here is a question, why am I keeping my eye on small caps as we move into the last quarter of this year? And there are several reasons behind that. Firstly, small cap companies are typically more sensitive to economic conditions. These businesses tend to rely more heavily on bank financing, and lower interest rates would reduce their borrowing costs and consequently unlock their growth potential. Additionally, small caps tend to be more domestically focused, and that makes them well positioned to capitalize if we see US economic landscape improving, as we already mentioned. Another important factor is the current concentration in large tech companies, especially those that are involved in artificial intelligence, because following the past earnings season, there have been growing concerns about AI giants meeting their high growth expectations. And this is also one of the reasons that has led to this rotation into small caps, which have been overlooked for quite some time. Because in fact, small caps have been trailing large caps for the last decade. The Russell 2000 index has posted an average annual return of about 9% over the past 10 years compared to SP 500 15%. And looking ahead, if current Wall Street estimates hold true, Russell 2000 is expected to see faster growth in both sales and earnings in the next year compared to SP 500. And as we enter this historically strong quarter, the growth potential of small caps becomes even more compelling. But that said, small caps also come with some risks involved. These companies tend to be more volatile because they are often reacting sharply to changes in economic conditions due to their size and also this reliance on external financing. And this volatility can lead to larger price swings. And besides that, small cap stocks are typically less liquid, meaning that they're less traded, and which makes buying and selling their shares more challenging at times. However, for investors that are willing to embrace those risks, the potential rewards are clear because small caps are currently trading at lower price to earnings ratio than large cap counterparts, which makes them an attractive diversification option as these conditions on the market shift. And the other topic that I wanted to cover, and JP already mentioned it, are home builders, because despite rising interest rates, home builders have been an outstanding performers in the market, especially in the US, because in the US, since central banks started tightening policy in March 2022, top 5 home builders by market value have delivered returns between 80% and 200%. And in comparison, in the same period, SP 500 has only returned about 30%. So many of you are probably wondering what is driving this growth. And because when interest rates rise, many homeowners were reluctant to give up their low fixed rate mortgages. And that resulted in fewer existing homes being put up for sale. And this has left home builders as one of the only reliable sources of housing supply, and they have just capitalized on this demand. Additionally, mortgage rates have reached about 8%, and now they're starting to ease. And because of that, many buyers are being drawn back to the market, which is further supporting the home builder stock. And looking ahead, central banks are starting to cut interest rates, and home builders could see even more demand as financing costs are decreasing. And this chronic shortage of homes in UK and in the US has been a problem since financial crisis in 2008. And that also plays a huge role because there simply isn't enough homes on the market to meet the demand. And if we mention the UK as well, a situation in UK is even more compelling because we saw many significant consolidation in the past 12 months, and today there are just a handful of companies who essentially control the market. Additionally, their business model is maybe less risky than business model of US home builders because they don't purchase the land outright, but they rather buy options, and that is reducing their capital needs and strengthening their balance sheets. And home builders in the UK, like Barratt Developers, Persimmon, and Taylor Whipley, are benefiting from those conditions. But at the same time, it's worth mentioning the UK housing market has its own characteristics. The new government has committed to reform the housing planning system, and they set an ambitious goal to build 1.5 million new homes over the next 5 years, which is really ambitious, and that should benefit home builders in the UK. However, at the same time, local councils, developers, and home builders in the UK are facing some bureaucratic delays, environmental regulation, and land supply limitation, and all of that is slowing down the process. But nevertheless, for the both markets, opportunities are evident, because when interest rates fall, we might expect further demand for new homes, especially if affordability improves. And this positions this sector for continued growth. But finding the best company in the sector might be challenging, but a well-constructed basket of few companies from UK and US could offer maybe better diversification for a cyclical play. But also here, as the same as small caps, here are also risks to consider. The housing market is highly cyclical in both countries. And for example, potential recession could reduce this demand because buyers would be more cautious. Besides that, construction is a slow and complex planning process, and that might delay some projects, even if the government is trying to boost the construction. Besides that, also affordability is a concern, because high home prices, despite falling interest rates, might keep buyers out of the market, and so limiting growth potentials of those companies.
Thank you very much, Neja. And I absolutely love the title and the pun, hammering out the future for home builders. I think that's my favorite. So that's the winner. We've got 6 questions coming up shortly, 3 for each of you, which have been sent in from our listeners. So we'll go through that in a moment. But just before we do get to the Q&A, JP, can you just give us a quick summary of the 2024 investment outlook?
Yeah, let's wrap this up. And the outlook, what you see here is not new. You know, we drafted this in December last year, and it's now a progressing story. So we see the Fed cut rates further. That helps broadening and rotation in risk-on markets, in equity markets. One of the sectors, not to heavily mention, is utilities. You saw that on Brad's sector performance. You know, they get a lot of money by tech companies to support the energy transition and to make sure there's enough electricity for everyone. So exciting times ahead. And with us talking about its rotation, as Brad also stressed, it's important to understand that we're not negative on tech. You know, we just see other sectors catching up. Well, with lower rates, at some point, perhaps not immediately, but at some point, cash will come into motion because the savings rates go down, and that will also put the bond market in motion. The weaker US dollar will help other asset categories like commodities and also other regions. But remember, you know, with somewhat softer economy, earnings growth is still strong and is now more divided and supported also in other sectors. And last but not least, crypto is still seen to profit from larger institutional inflows.
Thank you very much, JP. And as I said, we've got the Q&A coming up now, but just to wrap up the previous quarter, it's going to be an interesting next 3 months. I have to say, I'm really looking forward to that. Of course, we'll be back in 3 months to go through it all again. Look, we'll go through the Q&A. I'm going to start with Brett. So I'm going to come to you. We've had this sent in around tech. Is the opportunity in tech limited to the Magnificent Seven, or are there other opportunities?
No, I don't think the opportunity is limited to just the Magnificent Seven. Obviously, that Mag Seven is the front. It is the names that people think of most when they think of tech. But there's plenty of opportunity within the space. Even those are considered mega caps. Even if you go down to the mid and large caps, there's plenty of opportunities in tech. Cybersecurity, semiconductor names. These names continue to do quite well. The earnings expectations are quite strong for them. So no, I think there's multiple opportunities in tech.
Thank you very much. And you remembered the rule from last time in that all answers need to be under 1 minute. So tick already for Brett there. Neja, I'm going to come to you second there. You mentioned the narrowing performance gap between the Russell 2000 and the S&P 500 in recent months. What could cause this trend to continue or reverse?
Yeah, there are several factors that could affect both of the ways. This narrowing performance gap between Russell 2000 and S&P 500 could persist if US economy continues to stabilize. That is one of the first factor. Then we also need inflation moderating and a Federal Reserve to cut more interest rates. And these factors would benefit small caps, which rely more heavily on bank financing and are more sensitive to domestic economic conditions. Additionally, large cap tech stocks face potential growth limitations, which could also make investors rotate into small caps and drive further gains. However, we could see this trend in reverse if inflation spikes again or if economic growth slows. That's just because small caps are more volatile and dependent on external financing.
Thank you, Neja. And the last question of round one of the Q&A, JP, I'm coming to you. Do you think markets will finish the year positively?
Yeah, that's a good question, Sam. And we have debated that at length within our markets group and market analyst group at eToro. Looking at interest rates, there's a worry with some that, with this inverted yield curve where 2-year yields are higher than 10 years, that's now being reversed, that ultimately this needs to end in a recession one way or the other. But, for now, in our house view, we just don't see it. The cuts are helping the economy, reiterating what I said before, but the Fed sees the economic growth at 2%, unemployment peak at 4.4, inflation coming around at 2%, and we have strong earnings growth. So yes, although markets are already at all-time highs here and there, we still believe that the year end will be strong.
Thank you. Brett, I'm going to come back to you. We're going to focus this question on utilities, which obviously last quarter had a lot of focus on. Is this sector rally over for them?
Utilities have had a huge rally over the last few months. It's the best performing sector in the S&P. And because of that, the valuation is a little bit more stretched than it was when we talked about the group a couple months ago. But largely, this group still has the key catalysts in place. It still has strong earnings growth, still has a reasonable valuation. And as JP mentioned, mega cap tech, big tech names with their new AI applications and the power demand that those have, they have a new long-term catalyst helping fuel them along. So it wouldn't be odd to see some profit taking. If that happens, I'd say that's pretty normal. But largely speaking, the catalyst still remain in play for the long term.
Thank you. And Neja, another question for you. What are the key differences between the US and the UK housing markets that investors should be aware of when considering home builder stocks?
There are quite a few differences. I wouldn't say that any of the differences make one market better or more compelling than the other, but I think that investors should consider them before deciding to invest in any of those markets. Because in the US, home builders typically purchase land outright, and that can increase their financial risk, particularly in market downturns. But on the other hand, it also allows them to have more control over development. But on the other side, in UK home builders often buy land options rather than purchasing land directly. And I already mentioned that, but another major difference is consolidation. US market remains relatively fragmented, and UK market, on the other hand, has a significant consolidation, and there are only few companies dominating the landscape. Besides that, I would say that UK housing market is facing more bureaucratic delays and more strict rules when it comes to house building and development. And in the US, I would say there are more flexible laws. So I think that those are the main differences investors should consider before deciding to invest.
Thank you, Neja. I'm sure there'll be some people in the chat that have got an opinion or two about UK housing at the moment. JP, our final question from the Q&A. What is your key message for our retail investors?
Well, you know, at the end of this presentation, we started with the title, Change is Coming. It's time for value. This change is coming because we have seen the first rate cut by the Federal Reserve in 4 years' time. Yeah, and we believe there are more to come. So this change is happening. Now, no one needs to agree with us. It's important that self-directed investors decide for themselves what they believe will happen. But what we can say, this is the moment in time to look at your portfolio, to look at whether it's still suited for the time is coming. And it may be that it's geared towards too much towards tech or another sector, and you want to review it because the change is really there.
Thank you. And actually, just speaking about retail investors, we just recorded our latest Retail Investor Beat podcast. The survey is out. And of course, you can check out all the podcasts and videos and webinars and guides on the eToro Academy, and of course, digest and invest for everything that you need and more. JP, Brett, Neja, thank you as always. I'll see you all in 3 months' time.